I told them, if you retaliate, we're going to double it. And that's what I did with China, because they did retaliate. China's paid almost $700 billion in tariffs under me.
Easter weekend, Reuters shared photos of a 737 MAX touching down at Boeing Field, the plane maker's U.S. production hub, calling it a, quote, victim of Trump's tariff war, writing it's the latest sign of disruption to new aircraft deliveries.
China's government has reportedly ordered its domestic airlines to stop accepting deliveries of Boeing jets and to halt purchases of aircraft parts from the U.S.
Few observers thought the storm would arrive so quickly, but April 2025 delivered a shock that rattled the foundations of global aviation. With little fanfare, Beijing issued an announcement that would send tremors through boardrooms from Seattle to Singapore. Chinese airlines were to stop accepting deliveries of Boeing aircraft. For the American aerospace titan, the signal could not have been more brutal. Boeing had spent decades weaving itself into the fabric of Asian aviation, securing contracts, cultivating relationships, and selling not just aircraft but an image of trust and reliability. Overnight, one of its most vital markets, the world's second largest in aviation demand, was slammed shut. This was not a quiet market correction or a pause for technical reviews. Behind the decision was raw retaliation. Washington had just slapped a punitive 145% tariff on Chinese imports. Days later, Beijing struck back with a 125% levy on U.S. aircraft. The tariff was not symbolic. It was suffocating. The costs made Boeing planes effectively unsellable to Chinese carriers. The severity of the move was illustrated by extraordinary reports. Two newly delivered jets, already across the Pacific, had no buyers waiting to claim them. They were ordered to turn around, unwelcome in a market that had once been central to Boeing's global future. What looked, on the surface, like a dispute over tariffs quickly revealed itself as something far more sinister. This was not about the price of aircraft or the volume of trade. It was a political strike, deliberately aimed at Washington, designed to show that one of America's crown jewels, an industrial champion, a symbol of engineering prestige, could be turned into leverage in a much broader contest of power. The implications were chilling. If even Boeing could be expelled with a stroke of pen, what did that say about the durability of U.S. influence in the skies? The financial story that followed only deepened the unease. On paper, Boeing appeared to be finding momentum. In the first quarter of 2025, the company delivered 130 aircraft, compared to just 83 in the same period a year before. Revenue jumped to nearly $19.5 billion, a headline that might suggest a comeback story was underway. Yet beneath those numbers, the picture turned red. Despite the surge in deliveries, Boeing still posted a net loss of $31 million. That figure was dwarfed by last year's staggering $355 million loss, but it remained a loss nonetheless. For a company of Boeing scale, delivering more planes than ever yet bleeding cash at its core, the contradiction was impossible to ignore, investors noticed. Wall Street had already been unnerved by the infamous mid-air door panel blowout on a 737 MAX 9 early in the year. The incident had sparked global headlines, fueled public concern, and erased more than a third of Boeing's market value almost overnight, wiping tens of billions from its capitalization. Now, with China, once accounting for roughly 10% of its backlog, effectively sealed off, the pressure mounted further. Every lost order represented more than deferred revenue. It represented eroding trust, dwindling confidence, and the slow unraveling of Boeing's global stature. Financial strain, however, was only part of the story. Beneath the balance sheets lay a challenge far more existential: trust. For decades, Boeing's reputation had been its most powerful asset. The company's name alone carried an assurance that passengers would be safe, that airlines could rely on its aircraft to perform, and that investors could count on its stability. That reputation has been fractured. The turbulence of recent years left wounds that have not healed. Investigations into design flaws, regulatory failures, and management missteps cast shadows over Boeing's credibility. The world had not forgotten the 737 MAX crashes, nor the subsequent scrutiny of Boeing's corporate culture. Each headline, each probe, each delay or mishap cut into perception that Boeing was synonymous with safety and engineering excellence. China's decision to keep most of its orders on hold reinforced the point. Once considered Boeing's most promising growth frontier, China now serves as a reminder how fragile trust can be. Once broken, it is not easily restored, and the reputational scars extended beyond aviation that on the space front, Boeing's Starliner capsule, once touted as a flagship in America's new era of commercial spaceflight, suffered through delays, cost overruns, and high-profile test failures. Each stumble diminished Boeing's claim to being the pinnacle of aerospace innovation. Where the company once symbolized American engineering supremacy, it now faced skepticism. Boeing was no longer competing solely on price, efficiency, or performance. It was fighting for something more fundamental, the belief that its name still represented safety, reliability, and leadership. In an industry where trust is everything, that may be the steepest climb of all, these reputational fractures rippled into boardrooms around the world. Airlines that once locked themselves into decade-long purchase commitments were beginning to question their loyalty. Nowhere was this more evident than in Ryanair, Europe's largest low-cost carrier and historically one of Boeing's anchor customers. With more than 300 Boeing aircraft scheduled for delivery through 2034, Ryanair was supposed to be a stabilizing force for Boeing, guaranteeing billions in demand and keeping production lines humming. But in May 2025, CEO Michael O'Leary issued a warning that reverberated across the industry. If Boeing raised prices any higher, Ryanair would walk away. Contracts worth tens of billions could be abandoned. The IT wasn't empty rhetoric. O'Leary made it clear that Airbus, Boeing's European rival, and even China's Comac, with its C919 aircraft, were real alternatives. If either could offer a 10 to 20% discount, Ryanair would switch. For a deal valued at more than $30 billion, even modest pricing differences could tip the balance. The message was unmistakable. Boeing could no longer take its cornerstone customers for granted. This created a dangerous paradox. At the very moment Boeing most needed loyal clients to steady the ship, its most strategic partner was threatening to defect. Once stable contracts now hung by a thread. Meanwhile, Boeing's competitors wasted no time filling the void. Airbus, already the dominant alternative, has been consolidating its position. In China, it operates a major assembly line in Tianjin, a presence that gives it a local foothold and political goodwill at a time when Boeing is locked out. Beyond China, Airbus has deepened its partnership with India, one of the world's fastest-growing aviation markets. While Boeing struggles to reassure its partners, Airbus is embedding itself as a safer, steadier option at the same time. China's state-backed challenger, Comac, has seized the opportunity to push its C919 into the spotlight. With more than 1,000 orders already logged, mostly from domestic airlines, the jet is not just a national symbol. It is a serious bid to challenge the Boeing-Airbus duopoly. Analysts warn that the tariff war could become the very catalyst Comac needs, turning what was meant to be a domestic debut into a global arrival. The danger for Boeing is stark. What was once a two-player contest for dominance in global skies could soon become a three-way competition. With Beijing leveraging tariffs, subsidies, and industrial policy to accelerate COMAC's rise, Boeing risks being squeezed into a smaller role, reduced to a domestic American supplier while Airbus and Comac divide the global market. And the damage is not confined to Boeing's corporate balance sheet. The ripple effects are already being felt across the American economy. Each tariff escalation designed to punish China is ricocheting back into U.S. households. Rising grocery bills, higher utility costs, and stretched family budgets are all part of the fallout. Analysts estimate that trade measures now add roughly $2,800 a year in extra expenses for the average American family, a silent tax imposed not by choice, but by geopolitical confrontation. Jobs are equally vulnerable. Projections suggest that up to 641,000 American workers could be displaced as supply chains constrict and exports collapse. A half-point rise in unemployment may sound minor on paper, but in lived reality it represents hundreds of thousands of families losing paychecks, towns hollowed out, and entire industries scrambling to survive. Financial institutions confirm the trend. Goldman Sachs reports that companies have passed nearly 70% of tariff costs directly onto consumers, exacerbating inflation at a time when Americans are already under strain. Once one of America's proudest export engines, the aerospace industry, with a surplus once topping $75 billion, now finds its advantage eroding under the weight of retaliatory measures. What was intended as a demonstration of economic strength has become a drag on everyday life. The crisis is alarming not only because of Boeing's corporate struggles, but because of what they signify. For decades, Boeing's aircraft have been more than machines. They have been instruments of American soft power, extending the United States' presence into every airport, every airline, every continent. When that presence weakens, so too does a vital channel of American influence. Airbus is already working to consolidate Europe's role, leveraging steady production and reliable partnerships to present itself as a natural global alternative. Meanwhile, COMAC C919 is evolving from a domestic project into a geopolitical tool, positioning Beijing to project power through aviation, an arena long dominated by the West. The world of aviation is shifting toward a multipolar age. Airlines may soon be choosing between American, European, and Chinese visions of the future. And each time a Boeing jet is turned away, it represents more than a lost sale. It is another fragment of U.S. influence slipping quietly into history. Ultimately, Boeing's future is no longer just about aircraft deliveries or contract volumes.